recording. So this is the third community working session that we have. This is a part of our initiatives to get more community feedback and more community involvement, since our TGE didn't went as expected. Over the last couple of meetings, we have been able to understand that we are lacking some efforts when it comes to simplifying our communications and reaching the broader Cardano community, and that we also lacked, always in terms of communications, a better way to explain our whole model, to show how we're going to be providing value to holders and to platform participants as a whole. So the first session was just an introduction session about what happened in the TGE and what the next steps are. The second session was a session just revolving around communications and marketing. And now this session will be about utility. I think this is one of the most important sessions that we've had, because it will describe our whole platform and token utility model. So any feedback is welcomed, and anyone that is able to see this in the future, please feel free to jump into our Discord and just give us your opinions. Hello, MP. Thanks for joining. Just a heads up, this meeting is being recorded. So let us know if you're okay with us sharing it in our social media.
Sure.
So this is the agenda for today, a brief introduction to the Metera token, and we'll dive straight into the utility and protocol model. We'll go through the whole fee structure, like how Metera works, which fees are being collected, how we plan on adding Meteras and underlying of each one of our indexes, what you can do with those MTKs and possibly with Metera itself. That's like an open-ended question we'll discuss when we get there, and how we plan on bringing back all of the value to the Metera holders. We'll also discuss some of the utility that the token itself has when it comes to governance, and what voting power and capacity of decision holders will have into the protocol itself. So the overview, really quick, is we have a 1 billion supply. For the TGE, we were trying to reach a 24 million ADA valuation, which means each Metera token at 0.024 ADA. This is something that we are also thinking about changing when it comes to the new TGE, perhaps lowering our valuation in order to show a bigger upside in price impact. In simple terms, and we wanted to keep this very, very simple, just as an introduction, but we'll dive deeper into the utility of the token and each aspect. But basically, you need Metera in order to invest in one of our indexes, and you can use it to participate in governance. Perhaps we should have added into the bullet points that you'll also be earning dividends or some type of buyback mechanism yet to be defined as us as a community, and bringing value back to ISPO and NFT participants. Jumping straight into the fee structure and how the token plays a part, I'll first go into some of the fees that the protocol itself is charging. Some of those fees will go directly into OPEX, like the batching fee. Some of the fees will go to the index providers themselves, like the entry and exit fees, and the protocol fee will go directly to the DAO treasury, to a mechanism that we can decide together what to do with any ADA that is generated via the protocol fees. The fourth fee that we're seeing in the screen is Metera as an underlying asset in each one of our indexes. So the simple idea is that if you are investing, let's say that we as a DAO decide that 10% of that all indexes need to hold a 10% of Metera within them. 10% just being an example, it's way too high. But each time that someone wants to buy into an index, let's say with 100 ADA, they need to provide at least 10 ADA in Metera tokens in that transaction, which will create a buy pressure in the open market to get Metera into hands of users in order to mint those index tokens. All of these 4 fees or mechanisms are included in each one of the transactions. As we keep piling up fees, you probably get the question of, whoa, this might be too expensive. The service might be too expensive. But we'll also share a small comparison with the excess in the space of how our fee structure is compared in terms of pricing and how expensive we are against them. So let's get right into the batching fee. Perhaps show me some hands if or write in the chat. Is anyone here familiar with the term of batchers in the Cardano ecosystem? We are able to see them mainly in DXs in order to process transactions. So just let me know if you guys are aware of the term or not. Real quick to see how the crowd is feeling. Fluffy, do you know what batchings are?
Yeah, I can give a little light on it.
No, not for you to explain.
Yes.
I just want to know.
Oh, gotcha.
Yes or no, if we know what batchings are.
Yeah. Definitely let us know though, so we know what to cover.
So batchings on Cardano are needed in systems like DXs in order to process a bunch of transactions. The UTXO model in Cardano, in simple terms, is very restrictive on how much you can interact with a smart contract at any point in time. So usually DXs, which are not order books or regular DXs such as MinSwap or Sunday swaps, use batchers in order to do transaction chaining and to process more transactions directly into the smart contract and in the blockchain. Metera, in that sense, is pretty similar in the sense that on one end, on the right side, right here, we have our smart contracts that validate a lot of things, right? They validate that the proportions are right of the assets that are being provided. They validate that the transaction is coming from a wallet and perhaps not a script. And once the MTK is minted, that it goes directly to the wallet that created that same transaction. So we're validating a bunch of stuff which make it super restricted for a user to interact directly with the smart contract. That's why we have something in the middle, which we call the integration service, or basically a batcher. Which what happens if we follow the flow of how a transaction is built and processed via Metera is that users send the underlying assets. Let's say we have an MTK with 3 assets. They send the 3 individual assets in order to mint MTKs, and they send some ADA for fees. That order is received by our batcher, and they create a list of orders and they process them first come, first served. Into the smart contract, and they are also in charge of giving back the MTKs minted to the user. If someone were able to interact directly with the smart contracts, they would only be paying one transaction, right? But since we have a middleman, which is the batcher, we need to make sure that the batcher has enough funds to pay for multiple transactions, sending the underlying assets to the smart contract and then sending the MTKs back to the user. And that's where the term batching fee usually comes from. It's the money that the service needs in order to interact as a middleman. And the standard of the industry in Cardano for DXs and some other projects that use this type of models is 2 ADA fixed fee for this. So This represents a potential revenue model for Metera, either for the treasury or for us as a project in order to pay for OPEX, which is you don't usually use the two ADA in order to process a single transaction. So whatever doesn't get spent could be counted as profit for providing the service. Without us shifting away from the standard of the industry, we have decided to set a 2 ADA fixed price for our batching fee, which will be implemented whether a user is buying into an index or burning an index and receiving the underlying assets back. So far, any questions or anything that needs to be asked about the batching fees? In simple terms, it's in no way different to the batching fee that gets paid via DXs or different aggregators in the space. Awesome. So let's keep moving into our next fee that is included into the protocol itself. As we all know, Metera works alongside index providers or PMs that provide the weighting and the strategy for the tokenized index itself. Since they are providing a service, we have decided to give them the option to charge a fee for each intake or outtake of money from the index or from the strategy itself. This is a fee that is set by the portfolio manager once they create the portfolio. So we don't necessarily have an input of what a percentage could look like. Following the idea that in traditional finances, there's always a fight between PMs in order to provide a cheaper service. So without us not limiting what the entry and exit fee, what we hope to see moving forward is that portfolio managers keep changing those fees and competing against themselves in order to provide a cheaper service to the end user. As you can see in the screen, we are following the flow of a transaction where we simulate that a user buys 100 of these index tokens and they interact with an index that has a 1% of entry fee. The user will not have to pay that in ADA on top of what he's already sending. Instead, what we do via the integration service that we discussed or the batcher is that we'll just remove 1% of the total of the MTKs minted and we'll send that 1% to the portfolio manager and the 99% remainder back to the user. So this is a fee that happens either when you are providing liquidity into an index or burning an index. The portfolio manager has the flexibility to decide either one of the percentages. Also, any of those could be zero if a portfolio manager decides to do so. This is one of the fees that doesn't directly impact the utility of the token or that directly impacts value accrual back to the user, but it's a great incentive in order to get portfolio managers to do the best job that they can with the instruments that they are providing via the platform. Now let's move forward to something that is more of interest for this meeting, which is basically protocol fees and Metera as a percentage of the underlying assets within a portfolio. Sorry if this diagram is a little bit messy to follow. I don't know why I usually do diagrams from right to left instead of left to right. But the first part of this diagram is on the right side, where we can see an index, which is this green box right here, with three assets, right? Just a regular index from one of our partners or one of our community members, which has three assets weighted 50%, 25%, and 25%. since we have decided to just go ahead and launch our mainnet over the next weeks without us having a token event out, it's not possible for us to enforce a percentage of Metera within the underlying assets of the index itself. So once we go into mainnet, what we will be seeing is people creating indexes without taking into account Metera as an underlying asset. But as soon as we do, as a next step, our TGE, then we're able to enforce a percentage of Metera as part of the underlying assets. What does it mean? That the portfolio managers will need to rearrange their weights to accommodate any percentage that we decide that Metera needs to be held in each one of those indexes. We added 1% as an example and for simpler calculations for this meeting purpose, but this is something that is very much up for discussion with the community. I think this mechanism is really, really interesting. And if someone wants to add some points from the team on what they think about the mechanism, but it makes sure that Metera is in the center of everything and in the center of indexes in the Cardano ecosystem, right? If you guys have played around with our platform, you can either buy into an index with the underlying assets, or you can go through a DEX aggregator. By making sure that Metera is always enforced as an underlying asset in each one of the indexes, that means that we'll have organic buy pressure in the market as people try to mint index tokens. That also means that at any point in time, we can see that from the TVL that is held by our platform, 1% of value is always held in Metera tokens as well, since it's a requirement of launching indexes within the platform. And I think this is the first step to really understanding how we trickle back value to holders of the Metera tokens. And one of the utilities of what you guys as ISPO participants or NFT participants or Metera holders as a whole can start doing with Metera once it's out. On the left side, if we continue the flow, each time that someone interacts with our platform, whether that's a buy or a burn order, people will need to pay platform fees, right? We see this as trading fees in MinSwap or platform fees in some other protocols, but we're able to either decide a fixed ADA fee for each interaction within the platform or a percentage of the total order that a user is trying to build via the platform. Now, this is where we can start thinking together and perhaps getting some suggestions, because we don't necessarily have or understand which is the path forward that the community wants, is what we do with that ADA generated via the platform fees, right? It's very common in most projects or most crypto projects that whatever you are generating in platform fees, you're using to buy back your token and either burn it or distribute it back to the treasury, or some other projects like Indigo, from whatever they are generating in platform fees, they distribute it back to people that are staking or to holders as dividends. So I think this is the first major roadblock that we have right now, is that we don't necessarily know which mechanism people like better. A couple of weeks back, I had a very healthy discussion in the general chat with someone that claimed that buying and burning tokens was not a good enough mechanism to provide value back to holders. And at some point, I agree that it's just inflating the price, but superficially. But there are also some other issues with other mechanisms, such as dividends, mainly on the regulatory side. When you are paying dividends back from what you're generating in the platform. So this is something that, like I said, is still up for grabs and for discussion with the community. I know that people within the team have different opinions on what we should be doing, or perhaps we could be doing both, buying back some Metera and burning it, and some of the ADA we can be distributing back. So please let us know if you have any opinions towards this. Okay. Am I going too fast? Perhaps I would want to hear someone letting me know if this has been clear, or if there are any questions, or maybe someone in the team wants to include something to the discussion of the tentative mechanisms, because that's one of our roadblocks as it stands right now. So perhaps, Carlos, you can add some comments.
Yeah, basically we have like a bunch of possibilities of what we can do. Personally, I am more into, well, I have like both positions. I think that burning like makes sense, but here MP was the one that was like having the discussion like a weeks back, and I think he or she or they have like very interesting points. So, but what I am like more tentative about is like the paying out the dividends, right? Because like Metera protocol, as you know, is like two things. The first thing is like the technology provider, in which you can create like the empty case, like the tokenized indexes, and the other like pillar is like the Metera DAO, in which you can vote, in which you can approve, and in which we are going to shape and decide like the future of the protocol, basically. And I think that having like these dividends, let's call it like the dividends or rewards, makes sense to be like redistributed to the community itself and to the Metera holders. But yeah, if someone has like something, it will be great so that we can like discuss it, or maybe like let us know that you're here, like with a hands up, or a message in the chat as well.
Definitely. Something I might just add. This is the fun part, guys. You know, this is the early kind of DAO based decisions that we'll be making in the future, that's community led and driven. So yeah, you know, coming up with, we have obviously as the team have talked about, you know, some of the things that we think will be the best way going forward, but at the end of the day, you know, we want the community's insights and opinions on some of these topics of, you know, what would be the best use case for the platform fees, you know, how from a community perspective and investor perspective, what is a reasonable fee structure for you guys, just things like that. So yeah, just please let us know if this is making sense, and we'd love to hear you guys' thoughts.
Yes, also I just realized with your message, Carlos, that MP was the one making the arguments against the burn mechanism, and I agree with a lot of that. So yes, as Dawson you mentioned, this is part of the first decision making that we want to start having with the community. At the end of the day, anyone here that is an ISPO participant or NFT holder, or whether you haven't participated in Metera and are thinking about it, I think one of the most crucial things is how we are doing value accrual to the token with the platform, right? And besides the mechanism that we have already explained of having Metera as an underlying, there are still a lot of things that we can play around to have value accrual with the token, and the protocol fees are one of those things. If we think on the two sides, sorry. Okay, sweet, MP. We'll go through the whole presentation and come back to you. If we reduce the fee with the amount that we want to distribute back to the token holders, right, incentive to participate in the indexes. If we reduce the fee with the amount, I'm not sure I understand that. Does anyone understand that comment? Let me know.
Yeah, so basically, if you are like a Metera holder, you can have like a reduced fee when participating in the protocol. That is what you are meaning, Banu?
Yes, I guess that.
He's typing, but yeah, I believe that's what he's getting at, which is an interesting idea. And that's why we want
Yeah.
to, invite community ideas. A lot of you guys are all a part of all kinds of different ecosystems, have different backgrounds, have different opinions, perspectives, and that's really what we're wanting as the first index fund protocol coming to Cardano.
Yes, also, okay, let's say we want to charge 20% fee and we want to distribute 25 back to holders to burn our dividend. I'm not sure I'm grasping the concept here. To burn or
Hello,
dividend.
can you hear me?
Yes, yes. Sorry.
Oh, oh, I was just trying not to disturb you through the actual voice. So I'm just saying, so whenever we are like, let's say we are charging a fees of 20% flat fee on the performance of the index. So and whatever fee we are collecting, so and we are going to distribute like let's say 25% of that fees to the token holders through the mechanism of let's say buyback and burns or direct dividends. So we are just including too many steps to give the benefit back to the Matera holders. So instead of doing like jumping all these hoops, we could just have the 15% flat fees on the index instead of a 20% fees, because the the 5% that we are charging extra, we are only charging in the way that we will be distributing it back to the Matera holders. So maybe like instead of jumping all these hoops, just reduce the fees in hope of getting more and more participations in the index, and hopefully that like we will have a higher TVL and higher everything based on the smaller fees charged, and like better performance of the Metara protocol as a whole.
Okay, awesome.
Maybe I am thinking
No, I get that fully. I just think there's some misconception on the fee structure because this protocol fee is not a performance fee, as we can see in traditional funds, like the 220 rule, right? 2% management fee and 20% performance fee. We're not actually covering a performance fee right here. As part of the fees that the index provider is generating, right now what we have is the entry and exit fee. We don't have a performance fee yet. Actually, the
so yeah,
numbers.
so this 2% can also be reduced in the similar manner.
Yes, so kind of the range that we're thinking for the platform fee is 0.5% of all transactions had that people go through in the platform, and the question is what we do with that. I think some team members got the wrong impression with the initial comment, but I think that's a really interesting thing to explore. If we want to reduce platform fees for token holders, that could also make sense and add to the utility of the token. Like you would be buying into an index cheaper than the rest of people. Let me know, Banu, if that makes sense.
Yes, definitely, it makes a lot of sense. So I was just coming from the Zerberus space, so I had like their fee structure in mind.
Yes.
So I'm sorry about that. But yeah, if we are already having a like very less fees, then I don't think my idea will hold much weight. But yeah, still it can be explored. So sorry for lack of my knowledge.
No, that's completely fine, and thanks for joining. Also, this is something that we're discussing closely with our partners that are going to be launching indexes. Um, a performance fee is very, very difficult to calculate, and the mechanism is hard. We have been trying to figure out a way to do performance fees for a while now. Actually, there's a project called PBG Token that does a more centralized approach to asset management, which offers performance fee, but it's a whole thing where they send back an NFT and you need to calculate each entry of the user in order to know what to pay back in the performance fee. So for this first version of our platform, we're not including a performance fee. We're only including an entry and exit fee, which we covered in the previous slide. So let's keep moving forward with the next thing that is really important for utility, and this is something that we also are looking for feedback. Feel free to think about this. We'll share the slides with you guys so you can take a look around, and we can keep discussing in the general chat after we finish this call. But the next part is our staking mechanism. So as we were preparing, we were finishing the audit and we had some resources available on our end. We started working on some staking contracts which are basically done by this point. And what we're basically trying to do, and one cool thing is that this is all gonna be open sourced, and we should be going live soon with that repo as open source, is that we are trying to have a bootstrapping mechanism for the platform, right? A way to bootstrap TVL and to distribute Metera as TVL comes into the platform, trying to bring back value into the token. So the flow is that a user interacts with our DApp and buys an index token, right? Now the user has received the index token, and then they can go ahead and stake their index tokens, thus locking TVL into the platform and earn Metera tokens. In our previous tokenomics, the ones that we attempted to use for the TGE, taking into account 25% of our total supply to be distributed with this bootstrapping mechanism. And to provide more clarity, here's a graph of how that looks like. So if we look at this graph, the blue line is how much ADA is being deposited into the platform in terms of index tokens, or it's being staked in our staking contracts. And the red line shows how the rewards are being depleted over time as TVL comes, following the idea that each one, like everyone that wants to invest in an index in the long term, can stake their index tokens for 6 months and earn Metera in return. The special thing about this is that if we go back a couple of steps, is that each index token will also hold a percentage of Metera, right? So that means that we're not only locking value in of the index tokens that are being minted in the platform, but those index tokens also hold a percentage of Metera, which means that Metera is also being staked. And not in the simple form of just Metera, but in an instrument that is diversified with a bunch of other tokens. So in the graph right here, and this is always numbers that we can change and discuss together, but our initial proposal was to bootstrap around 80 million ADA into the staked into the platform and deplete 25% of our token supply. So as we keep growing on the left side on total TVL, you see an inverse curve that depletes Metera, and API starts to get regulated as more usage of the platform and staking of the index tokens is done. one thing that we were actually discussing within the team, and I would love to know if someone has some comments, is if we should also allow people to stake their Metera and alongside their index tokens. Right now, this mechanism was only thought as a way to bootstrap TVL into the platform in terms of index tokens themselves, but perhaps there's also an opportunity to allow people to stake their Metera tokens, which they are not using to participate into the indexes, and earn more Metera rewards over time. When we need to think about the whole flow of a token holder as the token goes live, right? You either participated in the TGE or have already accrued Metera over time, and now the platform is on mainnet. Now you are receiving Metera and you want to do something with that, right? You don't necessarily want it just holding it in your wallet and doing nothing. So there's a couple of routes that you could follow with this mechanism that we are suggesting. You can use your Metera in order to buy index tokens, right? Since it's an underlying asset in each one of the indexes. You can then stake those index tokens and receive Metera back. And as a third thing, you could also be staking that Metera alongside your index tokens. This stake Metera is also allowed in our staking contract, is something that we have not yet decided. And this is something fairly new. When we were designing this mechanism alongside Cerberus, which they helped us and advised us on our tokenomics and utility mechanisms, we were only thinking about the staking contracts as a bootstrapping mechanism for the platform itself. Like how this works and how this means value accrual is in simple terms that TVL in the platform means more Metera circulating and more Metera staked, right? Staking index tokens include Metera, and because of that, we are rewarding people with more Metera tokens. And as there is more transactionality within the platform, which allows TVL to increase, then we accrue more platform fees that can be used towards either a buyback and burn mechanism or a dividend mechanism. There are also opportunities to grab the platform fees, buy Metera, and circulate it back to our staking contracts to grow the amount of rewards held in the staking contract and give it as yield to people that are participating in the staking. So, like I said, I believe we have a very circular mechanism of the utility and value accrual. I think the model itself makes a lot of sense, but still needs a couple of tweaks and decision making on which are the best fee percentages, on if we should be focusing on only bootstrapping TVL to the platform or trying to have as much transactionality in order to generate platform fees and give back value to the Metera holders. So there's a lot to be discussed within this whole utility model that we would love to get opinions from the community. I have right here, as you can see, there's a bunch of fees built on top of our protocol. One of the things as we were designing Metera is that we were always very careful of not making the product super expensive because then people wouldn't participate. And even though we have batching fees, entry and exit fees, transaction fees, and a whole fee structure, we believe we're still performing as an asset management instrument when it comes to fees, right? So what we have on screen right now is a simulation of a transaction and a comparison with a simple swap in MinSwap. So on the left side, we simulate a user buying 4,000 ADA worth of MTKs and what they need to pay in order to make that transaction. So a fixed fee of 2 ADA for the batching fee, our proposed 0.5% of protocol fee, which amounts to 20 ADA, and an entry fee that goes directly into the PM that is not paid into the platform and is not paid in ADA. It's paid in MTKs minted, like we mentioned right here. If you buy 100, you receive only 99, and that one MTK goes back to the PM because you're paying for an asset management service. In total, what you are paying in value is around, for a 4,000 ADA transaction, is around 62 ADAs, with 40 ADA being just MTKs that go directly to the index provider, which amount to 1.55% in fees approximately for each transaction. If we simulate a similar amount on a swap or min swap, what we can see is that the user is straight up paying for this neck in trading fees, and that they have a slippage tolerance of 0.5%, which amount to 1.1% of total fees of the transaction, plus a potential 0.5% slippage. Okay, now let's go to the whole governance side. It's comparing apples and oranges in a way. There's no point really to buy a single asset index. No, I agree, but we need to compare ourselves to what people are paying in the just using DeFi in Cardano. I do believe, although we are a little bit higher, you are actually paying for a service, right? You're paying for an index token which gets balanced, and there's a portfolio manager with a strategy behind. And with ADX, you're just paying for a swap. Doesn't you want to add something? I see you muted yourself.
Oh, sorry, my bad.
All good.
Yeah,
Carlos.
it was just a quick comment.
Yes, please go ahead.
Oh, no, sorry, that was my comment. Like, I get what you're driving at, but the same token, it seems like the comparison is a little bit off, because to actually make the point for the index would be that you actually buy more than just a single asset to hold in the index. So you're kind of multiplying the the fees on the right side of that screen, like by the for each additional asset that would basically be part of the MTK, right?
You mean in order to buy into the index itself?
No, if you were to do it manually. So basically on your left hand is you're doing it the Metera MTK way, versus you basically going to buy individually what assets you would, instead of the MTK, you're basically, you're just going out and you're buying a bunch of random assets. So it's kind of like you kind of triple, like for argument's sake, if you're basically if you were to like run with sort of 3 meme coins, you would basically kind of, you would probably buy, only 1/3 of the ADA in Snack or whatever. You would kind of manually run your own MTK, so to speak. But then the fee structure on the right kind of changes, differently than it does on the left. If I'm making sense.
Yes, I mean, but I don't understand if you're saying it's cheaper to hold the index token or doing it yourself. That's where I'm getting a little bit lost.
I haven't really gone into the mathing it out. The point was more so, if you were to make a better comparison, it would be the left buys 4K ADA worth of MTKs, and on the right you buy, XK ADA in A, B, C, D, and whatever fees that aggregates.
Right, you're right. Also, one interesting thing that I don't know if you guys have seen when using MinSwap is that they have a basket order, because keep in mind that one limitation that we have as a product right now is that you need to provide the underlying assets, right? I mean, you either hold them or you buy them in somewhere like MinSwap. So unfortunately, you need to go through a DX in order to participate in our platform, right? You're not just only providing the ADA, and that means that each swap will generate fees by themselves, whether that's a batching fee or a trading fee. But if you go through basket swaps on MinSwap, there's a fixed fee of 4 ADA, which makes it a lot cheaper than going through a regular swap. So we're thinking about a 3 asset swap. That means you're paying 12 ADA via MinSwap with a basket buy. I'm receiving some of that back, let's say about 3 back. And then you would go ahead and do a transaction with Metera paying the same structure of fees. So at the end of the day, what we need to understand as a utility model is that we have a somewhat expensive model. We can always adjust the fees, and that's part of the DAO responsibilities and capacities to always adjust the fee structure, either to benefit holders or to make the instrument cheaper over the long run. But this is something to keep in mind, that when you are interacting with our platform, you already have to have the tokens themselves. And I do agree that a better comparison would be for us to break down the different swaps that would happen right here and how much you would be paying. Carlos, do you want to move forward with the
yeah.
governance?
No, I want to add something to the example. So this is like, you're right, like this is quite a super conservative like scenario, because like this what we intended is what we are like actually charging, what it's like on us, right? That is like basically the batching fee, the protocol fee, and the entry or exit fee. Those are like the fees that like our platform is charging. So if you are a person that holds all of the underlying assets, like you have them like in a separate way in your wallet, then there is not going to be like an extra like spend, to interacting with the protocol. But if you don't have, like, I don't know, if an MTK has 6 underlying assets and you only have 2 of them, then we are going to facilitate that so that you don't need to go to a DX, buy the right weights, come back to Metera, and to like provide the underlying assets. So we are simplifying like the user experience just by adding like an aggregator, which that aggregator is having like their own fees, but like that's like separate from the service that we are providing. But we are facilitating that to improve the user experience. Yeah, so you want to jump ahead with something else, Daniel?
No, I think now we can move over to the governance. And once we finish, I would love to open the floor to just general discussion of the model and what we can do to improve. I see some comments from Banu that I would like to discuss also. But please go ahead with governance.
Okay, yeah. Well, basically, like, as I mentioned before, like Metera protocol can do 2 things. The first thing is like the service provider of creating like the tokenized strategies, or the tokenized indexes, or tokenized portfolios, however you want to call it. We are going to call them tokenized indexes. And the second part is like what the Metera holders can do, because we are the technology providers in order to do that, but we are also like a community driven project that has like its own DAO and can make like decisions and can vote on a number of things. So one thing that the Metera DAO is going to do from a governance perspective is a bunch of things. So The first thing is the platform governance, which is basically like change the protocol parameters and the fees. So, for example, if we want to lower the platform fee to X number, then we can hold a vote and we can do that so that the protocol fee is lower. Or if we want to increase it, then we can do the same process. Also, from a legal perspective, and also to include like all of the community, in order for us to approve an MTK issuance, it has to be voted by the DAO. So if I'm a portfolio manager that is like external to Metera, I need the Metera DAO to approve me in order for me to create the MTK. And of course, as I mentioned, that we want to have like Metera own indexes, so community members can vote. I don't know. Let's say that Banu has like a great strategy and he wants to push like an index, so he can go with the community and he can share like, okay, I want this to be like an index owned by Metera. So the DAO can also like approve on those indexes. So internal and external. And the last thing is changes to the constitution. If we want to change something to the constitution, which is now a work in progress, we want to share this. We want to share this like as soon as possible. Then we can do that as well. And the other side that also it's super interesting is like the DAO treasury. So we want to create like a strategy for the DAO treasury in which, as Daniel mentioned before, like we can pay out like the rewards that strategy is having in forms of dividends to all of the community, right? So, but yeah, we can also vote for the DAO treasury, which is OPEX approval, the investment strategies, how much of the investment strategies we want to divide into dividends to the Metera holders, and yeah, basically that. I don't know. You want to add something else, Daniel, on that?
Oh, sorry, I was muted. Just touching back a little bit on the approval of the MTKs. We have mentioned this and we will go more public with this soon, is that we have a legal wrapper, which is on Marshall Islands DAO LLC, which will include all token holders of Metera. The idea for this legal wrapper is to provide security to the protocol, but also to portfolio managers. Lawal, could you please mute yourself? There is some feedback coming from your mic. Sorry. It's to have a legal wrapper that provides security to the protocol, but also to the portfolio managers themselves. Take into account that this is asset management decentralized, right? Which means that each MTK that is minted is collateralized one-to-one with underlying assets, and they are stored in a smart contract. The only decision making that a PM has over the funds is to change the target weights, which modify a signal on how assets are provided into the index in order to mint MTKs or burned from the index in order to remove the underlying assets. So this serves as a legal wrapper, and as Carlos mentioned, we will be pushing out a constitution of the DAO, which sets some responsibilities to some core members of the team and some responsibilities of the DAO, like approving the issuance of the indexes themselves. Okay. Bye, Fluffy. Thanks for joining. I want to go back, and also I would like to have some insight from MP and Banu on this whole what we should be doing with the platform fees and the staking. I see a comment that I'll put up in the screen right here. I don't know if you guys can see that. From Banu. But it basically says something I wrote for my friend comparing staking versus buy and burn a few weeks back and go through this later. I gave it a good thought about distribution of project revenue to the public through staking mechanisms and through buybacks. In the case of companies, companies don't hold their own shares, so the effect of distribution through dividend or through buybacks is much better than the blockchain. It don't suffer from inefficiencies if planned properly. The dividend only gets paid out to a few participating individuals, but the buyback pays to the market participants and the price is improved for rest. You can value a company by doing a PV, which is perhaps potential value of its future dividends. The giving
Value of
away,
dividend.
sorry,
Present value of dividends.
okay, present value of dividends. The giving away of the revenue split to the delegator stakers in the case of crypto is a very bad derivative of dividend distribution, and hence out cannot use the general dividend growth model here and can get proper valuation through this model. In the case of buybacks and burns, it is more similar to a general companies. But as you know, this does not help the company in any way to generate more revenue or acquire new customers. Yes, it's definitely helped them achieve a side goal of trying to register trading. So I align with you that buybacks and burns are better than plain dividend payout due to efficiency and achieving other goals. So again, these are not the buttons I will push to see increased use of the project, but just buyback and burns are better than staking. I agree with most of it. This is not necessarily the right mechanism in order to incentivize the usage of the platform. I really like. I think crypto projects, if we're being honest, don't necessarily need a token, right? If we are being 100% honest, you kind of have to bake the utility and the token into the protocol itself because it's one of the main mechanisms to fundraise and to get community involvement and usage of the platform itself. Um, for right now, I think one thing that we are lacking is incentives on why you should be participating into the protocol besides the value proposition of indexes and value by diversification and risk management over the long run. But perhaps there are still some ways where we can bake in certain incentives into using the platform itself and holding Metera at the same time. I think MP has some strong opinions on why burn mechanisms are really not useful and they superficially inflate the price. I tend to agree, with the exception that you are doing those buyback and burn mechanisms directly with what your platform is transaction, right? And you're also adding volume into the open market, which can help with value accrual and investor perception of the token. So I would love to open up the floor for any suggestions or general comments. Panu, if you want to expand on what you added and what I read, please feel free to do so. Um,
So I really like this space. So I jumped in between this space. So but I'm really liking whatever you guys are doing, the way you are explaining and all. So thanks a lot for that, and thank you for giving me the opportunity. But I think like I wrote down whatever I was thinking about. It was just a comparison between which thing is better. Is the staking better, or is the buyback and burns are buybacks and burn better? So I think I wrote all of my thoughts in there. Uh, and yes, you can do certain things where your tokens can be utilized to increase the usage of the platform. But yeah, I said that staking them or like buyback and burning them are not the main utility. So we are just playing with them. So other than that, I just wanted to ask a question. If I heard properly, Matera, I think, can be used to buy indexes. Is it correct?
Yes.
Okay.
Oh, we
So
we
now
we
one thing, yes, please.
oh sorry, yeah. You can do that, and like also we provide the technology to create those indexes. So the indexes that you mentioned that you were in a server's meeting. So the
No, no,
indexes that
not
they
not
have.
Zebras, but Zebras
Oh,
protocol as a whole. Like
okay,
when they
okay.
used to do
Well,
these spaces, I was involved a lot, and then also I was in Zebras, like working there. No,
okay.
not working, like in the
Yeah, yeah, yeah.
Discord and also the fee structure and all. I remember from their spaces, not particularly the Matera space.
Yeah, yeah, yeah. Well, so their indexes are powered by Metera. So
Yes.
we provide the technology so that they can create the indexes.
Mm. So I can use 100 ADA worth of Matera to buy the 100 ADA worth of any index that I choose. Hello?
Sorry, can you hear me?
Uh,
It's just a
No.
part.
yes.
Can you hear me right there?
Yes.
So no, you cannot use 100 ADA worth of Metera to buy 100 ADA worth of index tokens, but Metera is
Yes.
part of the underlying assets within the instrument itself, as we can see right here. So let me pull up real quick our platform right here. Okay. So this is our testnet as of right now. And what
Mhm.
we can see is an index created by servers, right? Which is called the short term alpha.
We are only seeing the previous screen.
Oh, sorry. Can you see this now?
Yes.
Okay. So what we have right here, let's give it a second for it to load, is an index created by servers, right? That has been running on testnet for the past 2 months. And what we can see if we scroll down is the allocation of different assets within the index, right? We can see the weights provided by servers. This is the strategy that is being suggested by servers and enforced by them, and this is the actual weights, right? Prices are constantly changing, and the basket changes of weights every minute or so as a price change comes through. So when a user wants um, to invest or actually mint an index token, what they need to do is that they provide the underlying assets themselves. So if we were to confirm, as we can see here, they need to provide X amount of copy. They are not providing any amount of Hunt because Hunt is slightly overweighted in the index right now. And they are providing some Iagon and some SNEC. So if we look at the transaction signing, this means that the user needs to provide the underlying assets, right, in the transaction. So you're not minting only with Metera in that case. What we're signaling to is that Metera will be part of the list of the underlying assets, always with a fixed target weight. That will drive buys on the open market depending on the actual weight and if it's needed within the index itself. Um, of course, we have always known that having the user holding all of the individual assets in order to build the transaction is a pretty shitty UI, if I can say it myself, because you need to go through different DXs or you have to buy it and whatever. That's why we have been working over the past few months with DEX aggregators in order to allow swaps directly from ADA into the index token itself, going through different routes and doing different swaps and etc. Since Metera is going to be included as an underlying asset, that means that Metera will always, when people are buying into an index, that will drive buys in the open market as part of the underlying assets, as it will drive buys in the open market to each one of the assets that is included in the index itself.
I have a follow-on question here.
Yes.
So, like just going with the example that I see here, so Copy has 21.48% target weight. So, assuming I already have 2100 ADA worth of Copy in my account, and I have, let's say, what's it, 7900 ADA in my wallet. So that's totaling to 10,000 ADA, 21,000, 2100 worth of Copy and 7900 worth of ADA. So can I use the combination of these two things, Copy plus ADA, to buy in the portfolio? So whatever I lack in my wallet got, so, is bought from the Mindswap and other DEX aggregators and all, and the Copy that I am holding in my wallet get utilized in the conversion of the index token. So
Yes.
that way I don't have to actually sell my Copy and other things. So is that possible right now, or is it something that's going to be built later on?
Yes, I mean, so what we do on the front end as we are calculating a buy order is that if you don't, we'll see what you have in the wallet and we'll send a signal to do a basket swap of the assets that you don't have in the wallet itself, right? So you would submit a basket buy for the remainder of the underlying assets that you don't hold. And after that, you would be prompted to build a transaction in order to mint the index tokens themselves. Take into mind that this is just the side of actually providing liquidity into the indexes, right? And minting the index token. The end result of this liquidity providing is actually having an index token that can be redeemed for underlying assets. So that means a huge potential, and some of the things that we have been working on the background from a strategic standpoint is how to create secondary market for the index tokens themselves, right? Usually when you look at ETFs, this is a really interesting concept, is that the ETF, since it's a tokenized basket of asset, that's it, right? Practically, it usually holds, it's more valuable in secondary markets because it's already basketed and it's being constantly rebalanced than the actual underlying assets being held in the ETF itself. So I think there's a lot of opportunities, and we have been speaking with our team to create some market making strategies and some external market makers desks to see how we can balance the portfolios and how we can balance the indexes, how we can break up the indexes for the underlying assets and find arbitrage opportunities, which can be part of our DAO treasury strategy and also as a general strategy on how to maintain Metera moving forward. So this is the current way that Metera works. As we grow and we move forward, there's a bunch of functionality that we want to keep adding, like automatic rebalancing, etc. The decision that we made where people need to provide the underlying assets themselves and not just ADA is because there's no straightforward way to buy the index with just ADA, right? What we would basically be doing would be a representation of your ADA in the underlying assets and not actually collateralizing the index tokens minted with the underlying assets provided by the LP provider. So the easiest way to think about Metera is an LP token, but with a bunch of assets within itself. And that LP token can be traded in secondary market. Any questions, guys? Anything that we want to add? I know we've gone a little bit overboard of our allotted time. 16 minutes past the hour, but I'm happy to engage in any questions or any comments that anyone might have, or general suggestions.
Actually, I have
Yes.
maybe more a question for Banu than to the team. I'm coming back to the dividend versus buyback burn. Like the first long paragraph in the case of companies, effect of distribution. I guess my question would be, if not doing dividends, what is my incentive for participating? The comment that he wrote in the chat.
Oh, so the thing is, when you are holding the shares of a company, you don't even have to participate. You just buy and hold your shares. And whenever the company is distributing the dividends, it is distributing the dividend to all the 100% of the shareholders. It's not only distributing the dividend to the people who are only staking the shares to the company in some manner. It is distributing the dividend to all each and every participant. There is no direct each and every shareholder. There is no particular participation from the side of the shareholders. Maybe like if you don't even vote, you don't do anything for the company, you are then going to get the dividend of the company. In the crypto world, we have somehow made a situation where not everybody is getting the dividend, only the people who are staking the token are getting the dividend. So this is a bad derivative of the dividend system which is existing in the company structure. So that's the point that I have made in regards to the dividends, or let's say staking rewards going to the people who are staking in the ecosystem. With the buybacks and burn, it is exactly this, like I would say 99% the same way the companies are doing the buybacks. So when a company is doing buyback, it is buying back the shares from the open market and burning them. Essentially, it's not like burning, but it's still burning the shares. So in what happens then is, so whoever wants to sell these shares sells the shares on the rate quoted by the company, and whoever is not selling the shares kind of get appreciated share price because the company bought back the shares. And the mechanism is say similar on the crypto side. So we see a effective, like a better system copied from the web 2 to web 3 side when we are actually doing the buyback and burn. And that was the only comparative that I was drawing between the staking mechanism and doing a buyback and burn. In buyback and the burn, just like the companies, you don't have to do anything. If you are just holding the token, you will get the appreciated value. Theoretically, I'm not saying actually that will happen, but theoretically you are getting the actually value. And if you really wanted to sell your tokens, you would have like made a bid on the tax, and the token project would have bought back. So everybody is getting the benefit if you are doing the buyback and burn. But again, I am not saying that any of these mechanism will drive the revenue and the usage of the platform, but there was just a comparison between buyback and the burn and the staking mechanism based on the systems that are getting followed in the regular world and the efficiency. Nothing related to will any of these things derive or convert into the platform getting utilized and all. So that's the point that I was trying to make. I think I made myself more clear with this clarification if I was not
Yep,
that
thanks.
clear in the message. And any points from your side on this?
Yeah, I mean, my perspective is that buybacks and burns are a pretty inefficient, not really inefficient, but to me it's not a really good use of working capital. Like I think you could be doing, you could actually allocate that to do other things.
Actually, 100% agreeing with you. Both these things, I don't find them actual, actual good utilization of the funds with the company. I 100% agree with you. So if you know if you like remember the concept, no, not remember, if you are aware of the concept. So if you are 100% sure that your company is going to do good, so it will be a much better thing that you utilize the revenues that you have generated into the company itself to grow it rather than distribute it. You only distribute the revenues and profits that you have earned when you are an old company which don't see a lot of potential in itself, in its growth and all. So I 100% agree with you. Because we are small firms and projects on the crypto side, we should be confident in whatever we are doing, and we should not be doing these distributions of the token through staking. And these are my opinions. I'm not laying out like anything other. So this is my opinion. We should not be doing these revenue giveaways. We should be deploying that capital into the infrastructure and all, because in crypto we are all like based on the assumption that we are growth firms, not the old firms which need to give away the capital, because utilizing that is not very efficient thing. 100% agree with you in this scenario, or like we should be utilizing the capitals in the development work and all, and not be giving them away until and unless we have reached the maturity stage of the projects. 100% agree with you.
So this is a really interesting conversation and helps us understand which perspective we should have moving forward, right? Because definitely I agree, especially being the from the protocol team. Like Cardano projects are barely making any revenue, right? And if you are making some revenue and you are using that revenue in order to either pay it back to holders, whether that's dividends or buyback and burn, it's efficient. I'll give you that point, MP. It's very inefficient, especially for the project, right? You need to think about it just using your revenue in order to provide more infrastructure and to keep the lights running. And that theoretically, of course, should bring back value to holders and to the project itself. The thing is that, I mean, I don't know if this is a straight criticism to the space or how the the mechanisms have been built around crypto and user expectations. But I one of the most common things that we've talked about and some of the more straightforward criticism over the past few weeks is how we are providing value back to token holders. Uh, and this is like a direct argument on how to provide back value to the token holders because people don't necessarily care how you keep the lights going. They think that you just have that responsibility, whether you're profitable or not, to just keep the lights going somehow. My next question would be, what are we looking to incentivize via the protocol? Are we looking to incentivize TVL via some type of staking? I understand that perhaps like Indigo does, like requiring you to stake your indie tokens in order to get some share of the revenue stream via dividends or buyback mechanisms. But they also require you to participate in a governance action each 90 days in order to receive that dividends. Is that a route that we think makes sense? Crypto as a whole, leaving aside companies and traditional companies, or should we focus on creating as much revenue possible for operation and providing value back to holders via having a better platform, better partnerships, uptime, whatever it might come to, or focus on using that revenue in order to incentivize specific actions within the protocol, like bootstrapping TVL? Those are the kind of concepts that we struggle with making final decisions towards, because in the discussion table there are people from all sides that want different things. But just so you guys are aware, these community working groups are exactly for that, right? To look at different opinions and to make decisions together, or at least allow us to understand different perspectives to make the best decision moving forward. So I don't know if any of you have any comments regarding this, what we should primarily focus as a crypto project.
All right, I'll bite. I mean, ultimately, the value should come from what the platform actually enables. So that's obviously a very long-term growth, road to take. On the what to do with, I think you're trying to in balancing the health of the platform itself and to encourage participation in the platform. I mean, to me, like, no matter which, ISP I look at, I would still, describe pretty much, most, if not all, sort of, Cardano projects as some pretty, scrappy startups. So, on one side, it's very much if you were to take the revenue and you would, allocate them towards research development, hire developers to flesh out a better platform faster, is contributing towards that long-term goal, versus if you start to chip away from that capital and start doling it out, that obviously detracts from that. On the other side, there is this piece of shouldn't there be something that gives back to the people actually participating in the platform. But then the question becomes, what are those meaningful participations that both help the platform and to some degree share reward risk that somebody might be taking in contributing their funds to the running of the platform?
Right. That's a tricky question, right? Because arguments to be done on how to provide, like, it makes the most sense, right? In order to provide value long term, keep the revenue, R&D, and hire people to make it faster, stronger, prettier, etc. Or provide immediate value back to holders, which could bring other benefits. I do agree. Like, if you are giving away your revenue, whether it's taking dividends, buyback, burn mechanisms, whatever, you might need to start chipping into your treasury for OPEX really quickly, right? Which is basically selling your token in the open market and dumping into holders, which is counterproductive, if that's a word in English. But it's not benefiting holders because you need to sell that in order to keep the lights on. So there's a thin line. I think what I take away from this conversation is that we need to find a way to directly provide utility for token holders as soon as the token is out. And that's one of the mistakes that we did attempting the TG earlier on without having this on mainnet. So we can capture back via only protocol usage some of the metadata that is circulating out there. And perhaps not focus on the short-term value buybacks or value accrual to holders, but instead having a really solid platform that creates some of the biggest indexes in the ecosystem. I think we have a pretty unique position in order to strike the market with one or two indexes that become the standard or the benchmark of the ecosystem. And if we are able to do that via a very good platform that has a lot of that works fine and keeps the indexes balanced and keeps adding more and more value into the ecosystem, then theoretically the token should be taken care of just for the value that we're providing into the ecosystem. So really interesting questions and conclusions, guys. I really appreciate it so much. We, as part of our ongoing initiatives, we will be sharing a constitution of the DAO in the next 1 or 2 weeks that we'll share a draft of the constitution that will include descriptions of all of our mechanisms. It's important to understand that each one of these mechanisms needs to be handled by the DAO, and the DAO needs to approve. So a final utility model will come with that constitution draft, and I would appreciate if everyone here can give us some comments. I'll make sure to reach out and ask for comments directly, um, preferably in the general chat, but privately is also welcomed and appreciated. I think we are an hour and a half into the meeting itself, so I'm gonna go ahead and just